Hello, my name is Vanida. Today we are going to look at another question on the financial statement of sole proprietorship. Good. So this question, as we have on our screens, it says we are to prepare for the income statement for the business for the year ended 31st December and the financial statement of financial position as at that date. Okay, good. So first of all, this question requires some working. We have to do some calculations and get the exact figure in which we are supposed to show under the statement. Okay, good. So we are going to work or calculate that. With the first additional information, we know that additional information items are going to be treated twice. Good. So it says here on A that on 30th December 2021, the business decided that thousands of the trade receivables balance should be written off as irrecoverable debts. Provision for doubtful debts is to be adjusted upwards by 200. Good. So first of all, the bad debts. If our trade receivables are owing us and we are saying that 1,000 was written off, we know we are not going to get that. First of all, it's in the additional information. We know that it's going to be an expense. It's an expense for us. Bad debts are expenses. Good. It's in the additional information. So first of all, that 1,000 is an expense. That 1,000, we know that it was the trade receivable that was going to pay us 1,000, and now we are writing it off. That means that the trade receivables is going to be less by what? 1,000. Good. So that 1,000 or the 1,000 here is the bad debts. Okay, so 1,000. So we'll show here that it's going to be in the balance sheet and what? Income statement. Good. Do you get it? Alright. Now, we also have, it says provision for doubtful debt is to be adjusted upwards by 200. Take note, this one is by. Okay, there is a difference between to and by. If the question says to, that means that that is the extent to which the provision has increased. But if it says by, that's the difference by which it has increased. So that by here, 200 here, is going to be shown in the income statement. Do you get it? Good. And since we know that it has been increased, it says adjusted upwards, increase. So knowing that increase alone means that it's going to be an expense. Do you get it? Good. So that provision for that project. Which is 200 is going to be in the income statement, and you are going to add it to the old provision for that project and show that amount in the what? Balance sheet. Good. Because it's supposed to be treated twice. It's in the additional information. So we know that it has adjusted upwards. That means an increase. The difference here by which it adjusted upwards was what? 200. That was the difference. It's going to be an expense. Good. That has been treated once. Now, additional info to twice. The 200 is then going to be added to the trial balance provision for that project. The total for which will be shown in the balance sheet. They get it has been treated twice. Good. Then we move on to the next one, which is electricity bill outstanding amount to 500 and a quarter of the total electricity consumed relates to trading. Good. We know that the trading is the gross profits, the items that we add and subtract to get our gross profit or loss. Good. So it says the electricity bill here. So the actual amount for electricity here was 2,000. Okay, because When we check in the trial balance, we will see that the debit side has electricity bill of 2,000, electricity, okay, an expense of 2,000. Good. So we'll show that 2,000 here. It says outstanding. And as I said, outstanding, it relates to that particular year, just that we have not paid for it. Do you get it? We have to add it to the actual amount paid, 2,000. So that 200, 500, sorry, that is here as outstanding for electricity bill is going to be added to the 2,000, which is going to give us 2,500. Okay, 2,500. Good. This 2,500 is what the question is saying that. It says, and a quarter of the total electricity consumed relates to trading. So getting this, a quarter of this relates to what? Trading. Do you get it? Good. So we are going to multiply it by 4. And what are we getting for the amount that relates to trading? 625. You get it? So we are going to show this at the trading, when we reach the trading. Good. So when we want to know the actual amount that is going to be shown at the expense side, we are going to subtract this from this. Okay. So the 2,500 minus 625. Okay. So this is going to trading. And after subtracting, we are going to get 1,875, which is going to the income statement, okay, which we know is an expense. Good. So that electricity bill outstanding 500, expenses owed, so liability, we know it will go to the balance sheet. Good. So that is all. So showing this, we'll show this at the income statement, at the expense side. Then this 625 will be shown in the trading profit and loss account. So we move on to the C. Insurance premium paid in advance was 200, and inventory at 31st December 2020 was valued at 70,000. Okay, the insurance premium here is an expense. The insurance here is an expense. And it says it was paid in advance. And as I've already said, in advance, it doesn't relate to that particular year. So we have to subtract from the initial insurance fee. Do you get it? So, insurance. The initial insurance in the question here was 1,000, right? Good. So the 1,000 here, then the advance or prepayment amount was 200. Okay, so paid in advance was 200. Good. So we are going to have 800 as our insurance, and it's going to the income statement. Okay. All right. Good. So let's even indicate the 200 to insurance prepaid. Okay, so we know that this insurance prepaid will go to the what? Balance sheet under the current asset. So that is all for the insurance. Then we move on to the inventory. It says it was valued at 70,000. There's no calculation for this. We know that it's an additional information. Okay, so we are just going to show it twice. So it will go to the trading profit and loss to less the cost of goods available for sale. Then it will be shown in the balance sheet, current assets as stock. You get it? We move to the D. Okay, D, which involves depreciation. Depreciation is charged on cost on the following rates: on fixtures and fittings, 5%, and motor vehicle and buildings, 10%. Good. So depreciation. Good. You see, it says on cost, so we are going to calculate on the cost of that item. Okay, the straight line method. So we have 10,000 as the fixtures and fittings. Okay, 10,000 as the fixtures and fittings. Here. And we have motor vehicle also having a 10% depreciation rate. Then what again do we have? We have buildings, yes. Buildings also, which is 10%. Buildings here is 10%. Okay. So motor vehicle was valued 30,000. Buildings was valued 120,000. Good. So we are going to look or calculate for the depreciation for all these assets. Good. So the 5% times 10,000 is going to give us 500. Then 10% times this is going to give us 3,000. This is going to give us 12,000. Okay. So this one is going to be shown in the income statement. Okay. So all these is going to be shown in the income statement. Okay. So even if you are able to identify them as I'm doing, when you are there, you just come here or refer back to pick them straight away into your format. Good. So that is all for the depreciation. If there was any other depreciation in the trial balance, so let's say there was motor vehicle provision for depreciation of, let's say, 500 in the trial balance. We know that this one actually is going to this actual amount is going to the expense. Okay, that 3,500, because we already have 500 depreciation for motor vehicle, so we have another 3,000 which we know is going to expense. Okay, that 500 will be added to this 3,000, making it 3,500. That 3,500 is what we are going to show in the balance sheet. But because there was no depreciation or initial depreciation in the travel, this one will be shown in the expense side. Then also again, this same amount that is gotten will be shown in the balance sheet. You get it? It's in the additional information. We are treating it twice. So that's all for the records. We move on straight to the format or the income statement, then we put them inside the format. Okay, so we move on to the income statement. Good. So with the income statement, we know that we are going to start with sales. Okay. So sales. So we'll check in the trial balance the sales figure in the trial balance. And in the trial balance, we have the sales to be 150,000 and 50. Good. Then we know that for sales returns. In the sales returns, we know that is at the debit side, and it is 250. So we are going to less the sales returns 250. Good. And we will have our net sales. The actual amount for the Net sales is 149,800. Good. Then we move to our less cost of sales. Then we know that we will start with our opening stock. In this question, we have our opening stock to be 60,000. Yes, 1st January 2021, 60,000. So come here. Then we'll add purchases, okay, to the purchases, which is 80,000 in the trial balance. $80,000. Then we'll check for any carriage inward. If there was any carriage inward, there is no carriage inward. So we move on to goods drawings. If there was any goods drawings, there was no goods drawings. Then we'll check for purchases returns. Yes, there was purchases returns, which we know will be at the credit side, and it is 200. 200 for purchases returns. Good. So we are going to less this. Then we'll get our cost of goods available for sale. Which in some other books you will see COGAS, which is the same thing. Cost of goods available for sale. Okay, which in some other books you see. Good. So our cost of goods available for sale here is 139,800. Then we'll check for our closing stock. Okay, so we'll look or we'll check in the question to find our closing stock. And the closing stock is in the additional information, which was 70,000. $70,000. So we know that we have to less the what? Closing stock. And the amount we are getting is 69,800. Which is the cost of goods sold. Good. When we reach here, you will see that the question said 1/4 of the total electricity consumed relates to trading. And after calculating what relates to trading, we have 625. Okay, so we added the owings of the electricity to the actual amount paid for electricity. We have 2,500. Then we calculated our 1/4 of that 2,500, and we had 625. So this is where we are going to show that electricity. Good. The electricity will be here, 625. So we are going to add that electricity. And when we add that electricity, we are going to have 70,425 as cost of sales. Okay, so this same 70,425 is going to be shown, 35 rather. No, fine here. So this same cost of sales here is going to be shown here and subtracted from the net sales. So this 70,525 will be here. We less from this net sales. Then we are going to get our gross profit. Do you get it? Good. So it's just basically a format. So just know the format. Work for your any adjustment that you have to do. input them into the format. Okay, good. Then when we subtract 70,425 from 149,800, we are going to get 79,375. Okay, good. So this is going to be our gross profit. Good. This cost of sales, will bring it here, subtract from this, and we'll get our gross profit. Now, after gross profit, you add other income. Good. So we have to add other income. Okay, so after getting our gross profit of 79,375, what we are going to do is that we are going to add other income. Okay, so we are going to check out for incomes, and we know that we are going to look out or check out at the credit side. So capital not an income, trade payable, liability, discounts. Discounts received here 1,000. So we have our discount received. It required or it needed no adjustment. So we bring it at 1,000 straight away. Good. Then we move to further to see if there is any total or there is any other income. Okay, so discount received was the only income here. Okay, so we have our total income. Then we move to less expenses. Okay, so with less expenses, we are going to check out for debits for at the debit column. Good. So we have advertising. Okay, we have advertising. Okay, let's list them. We have advertising, insurance. We have salaries, rates. We have discount allowed. We have electricity. General expense. Depreciation. Good. And we have three depreciations, right? So we are going to show all of them, and it was fixtures, motor vehicle, and buildings. So fixtures and fittings. Motor vehicle and buildings. Good. So now advertising. We check for advertising figure. It was 1,000 in the trial balance, and there was no adjustment for advertising. So we just show that 1,000. Good. Then the next item was insurance, which was 1,000 in the trial balance. But when we check the additional information, it says insurance premium paid in advance was 200. So advance, prepaid, subtract. So we are going to subtract that 200 from 1,000, and we are going to get 800 for insurance. Good. Then the next one is salaries. And in the trial balance, it was 45,000. There was no adjustment in the additional info, so we are going to show that 45,000. Good. Then the next one is rates. which was 1,000, and there was no adjustment in the additional info. So we move on to discount allowed. Discount allowed was 2,000. There was no adjustment to the same amount here. We move on to electricity. Yes, electricity, there was an adjustment made. Okay. It says that the electricity bill outstanding was 500. So, and a quarter of the total electricity consumed relates to trading. If this a quarter was not there, it means that the 500 plus the electricity amount in the trial balance, which is 2,000, which is 2,500, would have been shown here. Okay, but the question says a quarter of that 2,500 relates to trading. Okay, so if that quarter is relating to trading, that means that um, 3/4 of that amount will be relating to expense. And when you deduct that amount relating to trading from the 2,500, we are getting 1,875 as we've already done in the workings. Okay, 2,875 for the electricity. Then we move on to general expense. General expense was 2,000 in the trial balance, and there was no adjustment for general expense. So we show that same 2,000 here. Good. Then we move on to let's check in the additional information to see if there was any other expense in the additional information. Okay, there was a bad debt here, which is an expense. It says on 30th December 2021, the business decided that 1,000 of the trade receivables balance should be written off as irrecoverable. It's an expense, bad debt here. So that 1,000 we see is going to be bad debt. Okay, so there's no space. So we'll move when we are going to. So let's finish with the depreciation. So with the depreciation, we have fixtures and fittings to be 500, and motor vehicle we had a depreciation of 3,000, and for buildings we had a depreciation of 12,000. Okay, good. So these are the expenses. We'll check out for the additional info to get our other expenses too. Good. All right. So we are continuing to list our expenses. We have bad debts. Okay. The bad debt they said was written off was 1,000. Okay, so 1,000. Okay. The bad debt was 1,000. And let's check if there was any other expense here. We've done electricity, we've done insurance, depreciation is done. Okay, provision. Okay, written off as irrecoverable debt. And they said provision for doubtful debt is to be adjusted upwards by 200. Okay, so it's saying by. That's the difference by which the doubtful debt has been adjusted upwards. Okay, so that 200 is going to be shown as increase in provision for doubtful debt. Which is 200. Good. So we'll check out if there's any other depreciation, expense in the question. Okay. I think that's all for the expense. So we total all our expenses. Okay. So these expenses that we have here, we are going to total all of them. Then we will subtract from the total income that we have. Okay. Good. So after totaling this, we are going to get our total expense, which is going to give us 70,375. 70,375, which we will show here because the total income was here. Okay, it's just a continuation. So this total expense from the total income, we are going to get 10,000 as our net profit. Good. So our net profit is going to give us 10,000, and we are done for the income statement. Good. So now we move on to the statement of financial position. Okay, so we are going to continue with the statement of financial position. And as you know, we are going to start with the non-current assets. And for this question, the non-current assets were fixtures and fittings. We had motor vehicle, and also buildings. Okay. Good. So we know that the cost will be here, the old cost, the depreciation, and the new cost, which is the net book value. Okay, so in the trial balance, the fixtures and fittings was costing 10,000. Okay, and after we calculated for our depreciation, we had 500. Good. So you see, we've treated it twice. You see, we entered this in the income statement as an expense, then we are treating it again here because it was in the additional entry. Good. Now, motor vehicle was costing 30,000. And after depreciation, after calculating for depreciation, we had 3,000 as depreciation. Buildings was costing 120,000. Then after calculating our depreciation, we have 12,000. Close this, and work with this. Okay, so we are going to get 9,500 for this. We are going to less the depreciation from the cost. Okay, we are going to get 27,000 for this. Okay, good. So we are going to also work with this amount here. After closing this, subtracting this from this, and totaling this, we are going to close this and this. And we are also going to total this and get our total to what? Calculate for the sorry. So okay. Okay, so we are going to work, close this, and work with this. Okay. So we are going to check for the total of the amount. This one is going to give us 160,000. This one is also going to give us 15,500. And this one is going to give us 144,500. Good. Now, then we'll leave that. We'll come to our current assets. Okay. Based on liquidity, we start with stock. Then we know that, okay, our trade receivables will come. Okay, so the stock in the question was given to us 70,000. Okay, 70,000 for stock. And our trade receivable was 15,000. Yes, but it needs an adjustment. Okay, the trade receivables was 15,000 in the trial balance. But when we check the additional info, it says the business decided that 1,000 of the trade receivables balance should be written off. So we are going to write that off. Okay. So if you understand control account very well, you see that in the trade receivables, the bad debt will be written off. There is bad debt written off in the trade receivables. Okay, good. So with that bad debt written off, we are going to credit that bad debt written off in the trade receivables account. So something like the trade receivables account, you have the actual amount, which is 15,000. The bad debt written off here is 1,000. Okay, good. So you are going to less this from this. Okay, good. So you are going to get 14,000. But there was an increase. There was a provision, a new provision that we had. Okay, which was 1,002. It says it increased by 200 in the additional entry. We've treated it in the income statement as an expense. Okay, they said additional info, we should treat it twice. So what's the other treatment here? We are going to add that 200 to the 1,000. Okay, and it will be here as 1,200. Good. So we are going to let, first of all, bad debt. Then also our provision for doubtful debt. Good. So our trade receivables amounted to 15,000. Our bad debt 1,000. Then our provision for doubtful debt, which is 1,200. So after doing this, 15,000 minus 1,000 minus 1,200, we are going to get 12,800. Good. So this is what we are going to work with. Then we will continue listing our current assets. All right. Then we said expenses prepaid are current assets. Okay. So any expenses that was a prepayment or advance, it will be a current asset. Good. And any income owings will come here as a current asset. So let's check for any other current assets in the question. Okay, we had insurance prepaid of 200. We said paid in advance was 200, and the insurance there was an expense. Okay, so insurance prepaid, 200. Okay, now we move to any other. There's no income owings, there's no expense prepaid again. So we continue checking for current. We have bank. Okay, bank. And the bank here is 8,500. Good. So I think that's all for the current assets. So after doing this, we will add all our current assets and we are having 91,500. So it's just a format that we are following. They said additional information, we should treat it twice. Okay, good. So any item under the additional information is going to be treated twice. So just know the format and apply the working and the knowledge and the adjustment you know about the items. Good. We know that prepaid you have to subtract, owings you have to add. Okay, and that will be shown in the income statement. But that actual expense prepaid or that actual prepaid or owings is where you have to know that it's coming to current asset or current liability. You get it? And I said the expenses prepaid will fall under current asset. Income owings will fall under current asset. But the expenses owings or accruals will fall under current liabilities. Then the income prepaid will fall under current liabilities too. So you have to know the item involved in that prepaid or owings, whether an expense or an income. So we have current assets to be 91,500. Then we'll move to our current liabilities. Okay, which obviously we know that we are going to see trade payables. All right, so trade payables is 40,500. Trade payables 40,500. All right. Is there any other current liability? Good. We have bank overdraft. We have bank overdraft, which in the trial balance was 9,000. Okay, 9,000. You see, it was at the credit column. She is a liability. So you just have to go to the credit side because we are under liability. You just go to the credit side and search for your liability. I think for current liability, that's all. We'll check in the additional info to see if we have any current liabilities. Okay, we have electricity bill outstanding amount to 500. Okay, electricity here is an expense, and expenses outstanding, expenses accrued, expense owed. You know that they are current liabilities. You get it. So accrued electricity. That's 500. Good. So that's all for our current liabilities. You add these together, and you are going to get 50,000 for current liabilities. Okay, 50,000 for current liabilities. Then we'll subtract the liabilities from the current liabilities from the current assets to get our working capital. Okay. And our working capital is 41,500. 41,500, which we will add to the non-current assets, giving us 186,000. 186,000. Good. All right. So after working or computing for our finance by the second part of the balance sheet, we have to get this 186,000. Good. So let's move to the finance by. Okay, so we move on to the finance by. Okay, so for the finance by, we know that we are going to have capital. We had a net profit in our income statement. Then we'll check if there's any drawings. Okay, so the capital in the question was 86,000. Okay, so we are going to show that 86,000 here. We had a net profit of 10,000. So the 10,000 will be shown here. Then we'll check if we have any drawings. There was no drawings in the question. Good. So after doing this, you will add what we have here, 96,000. Then we move on to the non-current liability because we have loan here, bank loan. All right, so non-current liability. We have our bank loan there, which was 90,000. Okay, so 90,000. Good. So we have 186,000. Good. So when you get this, you know that you are on the right path. So this was equal to what we did, the first part of the financial position. Good. So that is all for this question. The next time we meet again, we will try solving different types of questions under the financial statement for sole proprietorship. But for now, goodbye.